Let's talk about how we get growth in our portfolios. And specifically, I think there's a lot of us that are striving for, I'm going to use the term growth. Like I want to say high returns. And we know that when you're trying to, invest, whether you're investing in real estate, whether you're investing in the markets, the stock markets, the bond markets, whether you're investing in, let's say, private equity, like no matter where your channel of investing is, I think we always kind of say, like, how do I get the best return possible? And with high return, and with any return, depending whether it's high or low, comes risk. And I think what we tend to want is those high returns, but I think are unsure about what is the amount of risk that is acceptable or optimal to get those returns. And so we're going to be kind of diving in here is looking at loss aversion, which, was talked about specifically in the book Misbehaving, The Making of Behavioral Economics by Dr. Richard Thaler. He based a lot of his work on Kahneman's and Tversky's work. So Daniel Kahneman, Amos Tversky, and behavioral economics. And so we're going to kind of unpack what loss aversion is and how it helps us kind of develop the spectrum of our risk tolerance and also our expected gains or expected returns. Because I think the spectrum of knowing where we are along that continuum of, I want high returns, but how much do I risk to get those high returns? Like, how much is acceptable? How much is optimized to do that can help us make decisions about our investments in real estate or investments in our portfolios or our financial freedom numbers, in trying to work towards those. So we're going to build that. We're going to be looking at that. We're going to be kind of unpacking how that relates to our 4 phases of wealth. Kyle, I'm excited to dig into this topic with you.
Yeah, you know what? This is a great book. So definitely head over to our book list if you have not checked it out yet over on CanadianWealthSecrets.com/books. We continue to add books to the list that are really helpful for all aspects of your wealth planning journey. And in particular, behavioral economics, I think, is so fascinating because it really brings in the emotional side of how we as humans behave. And unfortunately, like we talk about it all the time, rational thinking, like we can give you what makes sense from a rational perspective if we are willing to actually do those things. And unfortunately, as humans, I always like to say, we're like pretty smart, dumb creatures.
Yeah.
We do a lot of silly things, especially at the worst time when our emotions are high. They cited research in this book, Misbehaving, around risk aversion. And the interesting part was it was all about just a simple game and a simple experiment about flipping a coin. Now, all of us know, assuming it's not a weighted coin, this is an actual coin, it's a 50-50 chance of getting heads or tails, right? So not a really fun game if, let's say, you and I put some money in and, if you're heads and I'm tails, I win and then you win, we go back and forth over 100 trials or 1,000 trials or 10,000 trials, it's likely that we'll break even, and that would be a very, very not entertaining sort of way to do things. So what they did is they said, listen, if the coin flips heads, all right, I'm going to take $100. If the coin flips tails, you will lose. And the real question here was they were playing with different numbers to try to figure out at what point would someone actually take this game. So, if you're losing, the coin flips and it's a loss, you lose $100. How much do you need to win if the coin does the opposite and you get to take the money? And of course, if it was 100, you would think, I don't really want to play this game. Seems like a waste of time. But what would that number be? And the result from this, activity, the result from all of this experiment revealed something really, really fascinating. Now, if we talk about a casino, John, one of the best odds in our favor as a casino goer would be roulette, I believe. All right. And with roulette, the casino's really only getting like a very, very slight edge, right? They add the two greens, 0 and 00. And basically the way it works out is like the casino's only going to like take away like 5 or 6 cents for every dollar that you play on average over time. However, like these people weren't willing to take this game if they won $105 or $106. If it was, tails and they win, it wasn't even $110. It was $200 on average was what they wanted in return in order to take on this game, which if we pause for a second and think, I mean, of course I would love that, right? We're not talking like what would be the, they're not trying to maximize here. They were saying like, what would that number have to be for you to want to play this game? And basically they were saying, listen, I want to win double and you get to win half of what I get to win. That's like a massive, massive win, especially when we know over the long run, half of the flips are going to be tails, half are going to be heads. And of course, there's going to be a little bit of discrepancy in between, just like in the markets, how there's some discrepancy in between. But over the long run, things will be, of
Mhm.
course, well in your favor. And to me, it was shocking. I would love to play this game for a whole lot less than 200, but I get it because people do not like the idea of losing money.
For sure, for sure. Like, in when you think about playing the game, right? So you think like you were saying, like people aren't going to take the game if it was, I flip the coin. If I lose, I have to pay 100, or I lose $100. But if I win, $150. Obviously, they're saying it's not worth it for me to play this game because of the more adverse we are to loss. And that's the big findings from say the study from Tversky and Kahneman, which basically said like this 2-to-1 ratio became consistent for them. That basically we're saying is that losing money or losing something was felt worse by double compared to say winning the same amount. And that's like that 2-to-1 ratio is really the example of why loss hurts more than winning. It hurts twice as more than winning. And so that's a huge component of, I think, for behavioral economics, behavioral choices that we make in our everyday lives. And there's similar findings specifically with like world trade. There's an activity where you can trade things back and forth, and all of a sudden values go up because you're gaining something that you want, but then when you lose something you want, you devalue it. It's like there's a lot of nuance here in terms of specifically thinking about loss aversion. And so when we think about investment, we think about investing our dollars, there's huge implications here about our risk tolerance for gaining money in terms of say our retirements or our investments, for our portfolios, for real estate, or wherever we're investing our money. There's huge implications and broader implications about that for why we say are hesitant to invest. And I think there's that 2-to-1 ratio payoff is that we have to continually think about is if I put in $1,000, people are thinking, I've got to make 2,000 on this money because I'm risking my 1,000. Like this, there's always this doubling of like where this people go with this. Like this is why the rule of 72 is out there. It's because people are just constantly thinking about doubling their money or doubling their wins. And that's because of this 2-to-1 ratio. So, the loss aversion is huge in the way that we're structuring things. So Kyle, specifically thinking about loss aversion and how we're choosing to invest money, how does that implicate like this continuum we were talking about when say I'm a business owner and I'm an entrepreneur, I'm a real estate investor, I'm just an investor? How does that play into how we think about and how we should structure decision making for our futures?
Well, the part that I think makes it really tough is that we're all affected by loss aversion, and everyone is going to obviously be on some, spectrum of how much it affects them, right? Like some people are blessed with this ability to just go, you know what, I'm not going to get emotional about it. The challenge is that most people don't know it until it happens. Right. So when, things are going well, you're like, yeah, of course I'm risk tolerant. Like I can handle down swings and I understand the market. As soon as it happens, people get highly emotional and oftentimes we make poor choices. And so, the big connection here is that loss aversion is actually, there's a huge connection with suboptimal investment behavior. And today, what we wanted to talk to people about, everyone who's listening, is that somewhere you fit in somewhere in this, we'll call it a spectrum. It's sort of like, you're on this like continuum between, wanting, say, to have big returns. There's lots of people out there that are like, yep, all in on the return. I'm like, I want to maximize returns. But usually those people aren't really thinking too much about the risk part. So they're usually like not really concerned about that. However, when push comes to shove, those people who are on that end, they tend to invest less than they could or should, because that thought of getting the big gain, all of a sudden, it's like they start to recognize that as I push more and more money in, there's maybe a longer and longer time horizon before I may see that money, or maybe never see that money again. So, for
Mm.
example, I have a good friend who loves crypto, loves the idea of crypto. And when the crypto market is ripping, he's all in on crypto this, crypto that. The problem is, though, he only has like $10,000 invested in crypto. So he spends like a massive amount of time focused on the crypto market and new coin, this coin, meme coin, I don't know, all these different coins, but it's only with $10,000. And this person's personal net worth, I don't know what it is, to the penny or anything like that, but it is substantially more. That $10,000 probably represents about 1% of his portfolio, right? Or his personal net worth. And therefore, in his mind, he's going, I love the idea of the gains, the returns I can get in crypto, but he's unwilling to push in enough
Mm.
where it actually is going to make much of a difference, right? So it becomes more of a fun game. It becomes more of a fun thing to
I
do.
see.
And that's not actually going to necessarily result in anything specific. Now, on the other end of the spectrum, you have other people that are very aware that the loss piece is very concerning. And we're going to pick on business owners because we are business owners and we totally get this. And we're in this zone where when you run your own business, you already have the built-in risk of your business, right? So it's like your business is not guaranteed. You're not necessarily getting a paycheck next week if your business isn't doing well, or if tariffs have a negative impact on, what's going on in your world or what you're manufacturing or whatever it might be. You usually have way too much money on the sideline. So similar to the crypto experience, you would like the idea of a good return, but you also have the fear of, I don't know if my business is going to be successful this month, next year. And therefore they start to stockpile too much cash, usually sitting in just a savings account of some type, which is then losing money to inflation. And of course, any interest they are earning inside that corporate account is losing about 50% of it to passive income taxes. So you've got this like massive sort of two ends of the spectrum. You have people that are like super, return focused, but then it's like when it comes down to it, push comes to shove, they're unable to do anything significant with it. Not recommending everyone push all in on crypto, by the way, but that's a one example. And then on the other end of the spectrum, we have someone who goes, I recognize that my business is risky or that there's risk associated and that who knows if and when machines are going to go, or whether we need to invest in something, whether we lose an employee and we need to pay for somebody to come in and do something else. There's a lot of risk there. So they're keeping way too much on the sideline. And really today, what we want to talk about is how do we take the idea of loss aversion and try to use this idea to avoid us using suboptimal investment behavior, which usually go hand in hand when we start thinking about our emotional side and human economics,
Hmm.
or behavioral economics, I
Right.
should say.
For sure. For sure. When I'm thinking about these two ends of the spectrum, on the one side, I'm hearing you're saying that, there's a person that's like, I want high gains, but I'm not structuring my investments to gain those optimal gains. And it's probably because of our loss of. On the other side, you're saying that people also understand loss, but also aren't optimally, in making investment decisions, even though they may say, they're just more clear on like where they're trying to go. And I think both of these spectrums, like where you will live on this kind of like decision making kind of criteria is, I think, in order for you to decide where your aversion to loss lies, and where you're say, hey, I feel good about investing this many dollars in this area, or I'm investing this many dollars in this area, comes down to, I think, one of these phases of wealth creation that we've talked about here on the podcast, and how we help our, the clients that we support on an ongoing basis think about their portfolios is that first phase, which is about vision planning, for your wealth futures. And then what are some of those numbers that you're looking to secure? Like, we have to have a plan for where we're trying to go.
Mm.
And we have to know, like, what is my, say, fire number, or what is the number that is going to secure? What is that layer in my portfolio that I want to establish as my foundation? Like, obviously, your friend here has, like, probably has that phase of his wealth journey kind of a little bit mapped out. A lot of time, to be honest, a lot of the times what we talk with our clients and people initially, they're very unclear on phase one.
Hmm.
But I mean, like, for him to be like, I don't want to put more than $10,000 into this space because I don't want to risk my floor, my foundational floor, this layer that I know that needs to be protected to account for my future. But in order for you to know that, this person on that end of the spectrum must also know, hey, I've got this mapped out. I know where I'm trying to go. I know where this number needs to be. I know I need to make sure this floor is safe.
Hmm.
And the safe floor is in this asset, or it's in this asset and this asset. So they're making some really good decisions there on that end of the spectrum, and then going like, I'm okay with this being risked in this zone because of that. Now, if this is where the mismatch comes from, is that if I'm clear on where I want to go with my phase one, like, this is my fire number, this is where I want to retire, I've reverse engineered, here's my foundational floor that I'm structuring to make sure that I continually build on that to get towards my goal. Then if the mismatch is that I I'm unclear about that reverse engineering process, that I'm
Mm.
not actually investing enough in these high risk, say, assets to get the return that I'm actually after. So
Right.
if he wants that return and it's actually tied to his end goal, and he hasn't figured out that, like, actually investing more gets him towards the end goal on time, then he's got a mismatch there.
Sure.
And the same would be true at the other end of the spectrum. But both ends of those spectrums, we have to be really clear on phase one, which is like, where are we trying to go? What are the pieces that are going to help me get there? What is the timelines? Like, establishing that is so essential when to try to figure out where you are on this continuum you're talking about.
Right. And for this individual, you had mentioned like that they probably have clarity around that financial, foundation we call like the safety layer, whatever it might be. And actually, I'm not sure if there is clarity. Like I think they're investing and they're doing, a lot of the right things, but I don't know if they've actually done the work to sort of go, what would make me comfortable regardless of what happens with all of these investments, right? And I think that's true for the vast majority of people, as you had already mentioned, that thinking about what is it that I want, how am I going to get there? Because, for example, for this person, it's like a fraction of a fraction of a percent of his portfolio. It's in a sense, it's almost like a fun little hobby that he's doing. It's not really investing, right? Because you're taking such a small amount, committing so much time and energy to it. It's not going to actually have any sort of real impact on his portfolio unless he hits some sort of grand slam by accident, right? By, investing in some new coin or something like that, right? So this is a really, really tough thing for us as just being human, just typical humans, trying to think of what is it that I'm aiming for and what's going to help me get there. Because as you had mentioned, there's like a combination of like, we are always about volume, right? So the more that you can push to make your pile bigger, the better off you're going to be, of course. And we want to lean on returns, of course, in order to help us get there. But we don't want to be too, say, aggressive. We don't want to be too, we'll call it too focused on one company or one asset or anything like that. You want to make sure that you're well diversified enough to help you get to that place. And then we also want people sort of thinking about, like, what does that safety layer look like for me now and in the future? Now, why I say now is because if you don't think about how much of your investment portfolio is a part of your safety layer, then you might not invest enough because you might be too concerned that maybe I can't get that money back right away and I might need it. What if something happens in the house? What if something happens, especially for those business owners? So really thinking about like, what does that look like now? And then when I hit that financial freedom number, right? That fire number, first of all, if I don't know what that number is, this makes this work impossible, right? Like we have to have that in mind. When I get closer to that place, at what point would the loss aversion be too great for me that it would actually have an impact on my behavior, my emotions, right? Where, for example, let's say you have a fire number of $5 million, and you hit that $5 million goal. Would you be okay if the market took a massive downturn and you were 100%, equities, for example, and you went down to $2.5 million? Would that be okay for you? Right. And if the answer is no, then we have to start thinking about, like, so what portion of that should be in a safety layer? Now, on the other end of the spectrum, we talk to our business owner friends, for example, who have lots and lots of cash. Like, if your business is so awesome and cash flowing and all of these things that you're able to get to your financial freedom number without taking on as much or maybe any of the risk that others are doing when maybe they have a T4 income and they have a solid job and they can push more in over there, they might be fine to build this pile up with pretty risk off assets. Like, that's possible. It might not be optimal, but that's something that could be achieved. But the big thing is that you have to at least know. So you've got to start with getting that vision going so you could go, okay, this is where I want to get to. Here's the timeline I'm aiming for. And what does it look like if I keep doing what I'm doing?
Hmm.
Because that quote, John, and I'll let you pull, I can't recall the book it's from, but the quote around the idea that your plan, your system is perfectly designed to get you the results you're getting is exactly what will happen for you on the investment side of things. So it's like, if I'm setting up my life and I'm just putting some money in a savings account as a business owner and I'm not really doing much else other than that, well, let's project that out and see what's that going to get you. Because if you keep doing that, you're going to get that exact result that you're after. On the other hand of the spectrum, if I'm pushing all into equities, like, what does that look like and sound like? And what might that look like along the way with some of those dips? And am I okay? And here's
Hmm.
the crazy part: there's no right or wrong to it. It's about figuring out what's going to be best for you so that you can get there as best you can with, I'll call it the straightest path, but the straightest path that works for you, because it might be wavy for some people that are more risk on, and that's
Right.
okay too. But it's about knowing the path you're on and whether you're willing to walk it, and can you walk it when the path gets a little bit bumpy.
Yeah. Now that book that you're referencing is called Reset by Dan Heath,
That's
and
right.
the quote is, "Your system is perfectly designed to get you the results you're getting. And if you're not willing to say change your system or adjust your system, you will never change your current results." We talked about that in a bunch of episodes in a recent, if I'm going to go back and talk about your layers, and when I equate the layers, like your safety layer is like when go back to that coin flip. It's like, I'm going to flip the coin and I'm not willing to give up $100 unless I get $200 in terms of wins. It's like that safety layer is like, what is that expected value that I don't want to lose? Like, I don't want to lose blank. I don't want, like, that's your safety layer. And so I think some people, like you just talked about, like, you have to decide where your safety layer is, that you're willing to say, like, this is the loss aversion I'm not willing, this is the loss I'm not willing to say compromise on, because it's the foundation of where I'm trying to go. And I know that it will change as you get older. It changes as you get closer to, say, those goals that you're setting for yourself. So there's lots of different rules of thumb out there, maybe based on your age, or maybe it's the 60-40, and then you slowly change that portfolio structure to be something different. Some people say it's like based off how much knowledge. Like, for example, that person could be probably who knows so much about the crypto industry. If he knows front, back, side,
Mhm.
details, sometimes you might say that there's no risk when you know so much. Like, I know we talked about this before with that. Grant Cardone was heavily involved in real estate investing, and to him that was not risky. Alex Hermosi is heavily involved in building businesses, and to him that is not a risk. There's no risk there, so he doesn't
Mhm.
have as much, say, aversion to risk in that zone. But Alex said he would have to completely switch his loss aversion strategies if he all of a sudden became, into real estate, because he doesn't feel like he knows a lot.
Right.
So all of a sudden the risk definition is different there. So when we think about our portfolio, or like our portfolios in this like layer of protection, like this floor that we're talking about, Like, talk to me about like what that looks like. So let's not talk about like the percentage of your portfolio because there's tons of rules of thumb out there. But what does that layer look like? Like
Mhm.
what are we is it all fixed income? Like what are we talking about here when we talk about like what this layer could look like?
Yeah, I mean for us, our biggest thing is all about that layer. The safety layer for us is essentially not having the number go down, right? So for some people, that might be high interest savings account. Now, unfortunately for our incorporated business owners, it's not a great move because you're going to lose half of it to passive income tax. So not exactly helpful for incorporated business owners, but if let's say you are a T4 employee and you're earning income and you've got a nice high interest savings account and you want to put some in there. I might argue, though, doing more like GICs or, treasuries or anything like that for some of that portion. It might not be the whole thing,
Mm-hmm.
but I usually like to think of it as like starts off early in the early stages as a bit of an emergency fund. This can be for a personal household, but it can also be for the business as well, right? Because businesses need an emergency fund. That's why they keep so much cash on hand. And the other option is we could go into other fixed income asset classes, like, say, bonds, for example. The
Mm-hmm.
problem with the bond market is that they're very volatile, right? Unless you're buying a bond and you want to hold it until maturity, so you're just going to get the yield that's owing to you and you'll get your money back at the end. That's not usually how bonds work. Usually you're trading bonds just like you trade stocks. And unfortunately, as interest rates go up, bond yield, or not the bond yield, but the value of the bond goes down, right? So it's very volatile. So even a 60-40 traditional portfolio using stocks or equities and bonds is not a great move for that asset class. So the asset class we utilize, and again, full disclosure, we are business owners. So a lot of our funds are in our corporate structures. We utilize permanent insurance because we know that we can design them so that we can have a high early cash value, so that we can keep liquidity through leverage. And we get to grow this asset while also creating a legacy tool down the road. And like we talked a lot about phase one and getting your goal setting, we're kind of digging into this idea of creating your reservoir, right? Your wealth reservoir going. Like this is part of that safety fund. But then it also automatically helps us deal with phase four, which a lot of people don't actually get to in their journey, probably because they get so hung up in these first couple of phases, right? Getting clear, trying to figure out what their wealth reservoir is, starting to grow the pile is in that third phase. That fourth phase is all about legacy and like what's going to happen down the road. Well, we get kind of a 2-for-1 when we set up a high early cash value permanent policy, and we utilize that as our safety layer, but we also aren't restricted from utilizing some of those funds for more risk on assets. So for us, it's kind of like a flywheel where we go, okay, we want to create more safety. As that safety layer gets thick, and maybe it can never be too thick, but if it gets past the point at which we're like, okay, we don't need that much in our safety layer right now, we can then utilize some of those funds through leverage to buy more risk on assets. And what we get is kind of the 2-for-1. We get to grow our safety. We know that that's not going to go backwards. Amazing. And we get to buy more risk on assets with it. So we kind of get both ends of the spectrum, but all within, we'll call it what we feel we are okay to take on when it comes to risk aversion. Because I will tell you this much, I am, as much as I know about this field, this industry and finance and wealth building, it's still it still gets me hard, when all of a sudden I just it's like a knife in my gut when there's a big loss, when the market dips and I've got too much money in there. I think that may have came out
I
wrong.
think it did.
We're gonna have to cut that right there. So even though I know quite a bit about the market and I understand wealth building and I do all of this and I help so many clients with it, I'm telling you this openly and transparently that I still get really, really emotional when markets aren't behaving as I'd like to see them, right? As much as I know it and I know how I should feel, I still don't like it. And the same's true when an investment property, things not going very well. It still gets me emotionally, even though I try to prepare for it and I try to, find ways to deal with it. So for me, and I know, John, you're very similar, we like to have this balance between our safety layer growing and our risk on layer growing. And ultimately, in my world, this may not be for everyone listening, but in my world, I want to get my safety layer to what I call my financial freedom number base case, which is
Mm-hmm.
basically that I would be able to maintain my current lifestyle and expenses if I just lived off of my safety bucket. And then the rest is all for wealth building and growth. And it's kind of, I look at it as like a bonus, it's a cherry on top, so that
Mm-hmm.
as I live and as I move through this world, that I'll get to a place where I can still be spending a fair bit of money out of my portfolio without watching that number like going down, because that's what ends up happening in a lot of cases when we use a decumulation method. Is we're working our entire life to grow the pile and then protect the pile and then keep the pile, but then all of a sudden we're like, well, now we're going to spend the pile. And as long as we don't spend the pile before we pass on, we're good. But I'll tell you that I'm not going to like feel very good at 70, 80, 90, if I'm 100, watching that my net worth has just been dwindling away further and further and further. I actually want to see the opposite happening. So having this like nice, we'll call
Mm-hmm.
it play between the safety layer and your growth layer is really, really important, in my opinion, or at least in my planning. And I feel like a lot of people listening could probably relate to that as well.
For sure, for sure. And I think, you highlighted, three of the four phases that we talk with our clients. We talk with, prospective clients when we're trying to structure their wealth planning journeys. Being we have to have a very clear vision of where we're trying to hit. What does our life look like? 10 years, 20 years, 30 years down the road. Like, what does that look like? Sound like? What are some of those numbers that we can plan for? And then, phase two is about establishing that reservoir, whether it's at the corporate level or at the personal level. What is that emergency fund? What is that opportunity fund? Can we make sure that we're, doing those for both? And that, like we're structuring, becomes our safety floor. And that safety floor allows us to think about in better terms and really get more clear on this dilemma that we're talking about here, which is about this coin flip idea, this version to loss we humans have, and actually how it has dictated our decision making, because we view loss as twice as badly as gains. And knowing that fact and pairing that fact with having your system structured to be rules based, and specifically having your wealth reservoir created and set and structured and planned out according to your phase one goals. That's how you can then say optimize and avoid this like coin flip that helps, that dictates our decision making. And that's kind of my big takeaway here, is to think about that, knowing these pieces and how these pieces fit together, and knowing we're predisposed to think this way, actually how we can reverse engineer so that when downturns happen, we're already planned for them. We've
Mm.
already structured different pieces to make sure that we're not going to all of a sudden make rash decisions because we're worried about our loss and our aversion to loss. So that's my big takeaway. So I just only talked about two of those big four phases. The third phase you mentioned, which is really the fourth phase, which is about legacy and structuring the legacy that you want to leave, and basically your estate planning. You can do those through like the methods that you just said, through using your wealth reservoir as a means to make sure that you're planning for that legacy as well. The third phase is about, not just growing your wealth, but optimizing your wealth. Like you said, called it protecting the pile. Like, what are the structures, what are the strategies that we can be putting into place to actually, you know make sure that we're not paying more tax than what we could be? How do we make sure that we're making use of the different, say, buckets that we have so that we can build our wealth even more optimized than, say, just plugging and playing? So those are really the four big phases that we view as essential to making sure that you've structured in your system around those four, so that you can hit those goals, which is established in the first.
Hey, and if you're curious to see how you're doing along the journey, head on over to our Pathways page so that you can take a look and figure out which phases of wealth are working out well for you right now and where you could use some work. Head on over to CanadianWealthSecrets.com/pathways. And of course, if you're interested in hopping on a discovery call, we always love chatting, especially with our podcast listeners. So head on over to CanadianWealthSecrets.com/discovery